Hello everyone, my name is Torin Dove, and welcome to the Dove Financial Channel. Today we're going to be going over a Microcap Mania. Specifically, for the goal of this video, I wanted to target something in the financial sector. We have a very diverse portfolio going on right now, and I notice we don't have anything in financials. Now, financials can provide stability and also be a great source of income in terms of dividends to any portfolio, and so I really wanted to target this. Primarily what kind of got me super interested in trying to target a financial sector company was anytime I go through my series of filters, I'm always bombarded by regional banks. Now, I think this is kind of a good thing in a way because a lot of regional banks have cheaper valuations because there isn't really any growth expectations in them at all. But I was finally sick of pouring through dozens and dozens and hundreds of regional banks that I eventually just said, you know what, we'll find something in the financial sector. And originally I was looking at some of these banks, but again, as I've mentioned, there's not a lot of necessarily growth expectations built into these publicly traded microcap banking stocks. A lot of them are kind of just content to exist in their tiny niche, and oh, we have 7 banks in Oklahoma, oh, we have 5 banks in Texas, oh, we have 7 banks in Nebraska. One day we might be acquired by a big bank, but currently right now we're losing deposits and market share. Now, that's kind of a generalization, but that's typically how those stories go, especially the farther you dig into them. Decreasing deposits, we can't compete with any of the big banks, and we're just here to service very tiny communities. Which again, we love those banks, but there's not necessarily a lot of investability, and there's not a lot of growth that happens in that industry. So I stumbled upon Hennessy Advisors. Now, for those of you who don't know, Hennessy Advisors operates 16 mutual funds and 1 ETF. They specifically opened up in 1989, founded by Neil J. Hennessy in the San Francisco Bay Area, and then the firm became SEC registered as an investment advisor in 1990 before transitioning to managing mutual funds and having its IPO in 2002. Now, currently the company has $4.3 billion in assets under management and is headquartered out of Novato, California, with offices in Boston, Chapel Hill, North Carolina, and Austin, Texas. Now, Hennessy Advisors is a very interesting one because they're primarily known for their mutual fund, the Microcap 30, and this has been the source of several Yahoo Finance visits for Neil J. Hennessy and for many of his investment team, because that's the fund that, if any of you have seen the ads, they successfully acquired. Like, they added in Abercrombie and Finch, Super Microcomputers before it had its major explosion up, Gap. Basically, their entire purpose of that is they do a very quantitative approach, which completely eliminates any bias whatsoever or any emotions. They do a very specific set of filters we'll get into earlier on, and then they invest in 30 companies evenly. So that was really what I knew Hennessy Advisors for, was that specific mutual fund, but they also have 15 other ones. Now, not all of them are as high quality as that one specific one, but they're still investable, especially on, like, in terms of institutional expense ratios. A lot of the investor-specific expense ratios that you pay for some of the Hennessy funds aren't necessarily the most worth it, but we'll get into that in a little bit. So the funds primarily split into 3 categories: the domestic equity, multi-asset, and then the sector and specialty-specific products. Currently, the shares of each of these funds are only available to those living in the United States or U.S. citizens living abroad. Now, in terms of the domestic equity, we have the Hennessy Cornerstone Growth Fund, which seeks long-term growth of capital by investing in growth-oriented common stocks. The fund invests in 50 common stocks that fit the following criteria: over 175 million market cap, price-to-sales ratio below 1.5, growth in annual earnings, and positive stock price appreciation in the 6-month or 3-month period that they're examining. Now, those same criteria, especially the price to sales below 1.5, is going to be repeated consistently in a lot of these strategies that they have for their funds. I didn't feel the need to necessarily go over that every single time it's brought up because it's in the majority of their funds, but that's kind of like a core belief and core principle of the company is they won't pay more than $1.50 for each dollar in sales that company brings in. Then we have the focus fund. This one kind of missable. The portfolio managers in essence pick 25 companies they believe will do well and weight by conviction. That fund hasn't necessarily done well. It's seen some of the most the most amount of money pulled out of the fund, similar to a couple other ones down the list. Now, the Cornerstone Mid-Cap 30 Fund, again, as I've already mentioned, it's basically the exact same concept as the Cornerstone Growth Fund, again, with those same criteria, except that it is 30 mid-cap companies, and they try and do even weighting about, so it's somewhere in the 3% range, as Neil J. Hennessy went on to talk about, and I saw one of these videos that for specifically the Abercrombie and Finch and the Gap and the super microcomputers that we've brought up multiple times, they run those same set of basically just filtering out all the companies in the investable universe. They then weight who's seen the most growth in sales, who has some of the lower price to sales ratios, and pick the 30 most attractive names, and they try and get those again at an even 3%, but with how those companies typically perform in that set 1 year, some of them end up growing to 5% of the portfolio strictly through a price appreciation. And so this is one that's very, very well known in terms of any of their mutual fund offerings. It by far brings in the most new investors and brings in the most amount of money in terms of who wants to invest with this strategy as, again, most successful strategy and their most well-known offering. Then we go to the Cornerstone Large Growth Fund. This fund invests in 50 companies that meet the following criteria: above average market capitalization, again, price to cash flow ratio below the median of the remaining securities, positive total capital, and highest 1 year return on total capital. So also adding in the momentum aspect. Then we get to their value fund, invest in 50 large dividend companies using the following criteria: highest dividend yields that also have above average market capitalization, above average shares outstanding, 12-month sales that are 50% above average, and above average cash flows. Then we kind of get into some of their multi-asset funds. So they have the Total Return Fund. 50% of the assets in this fund are put in the top dividend-paying companies in the Dow Jones, the dog of the Dows, in equal dollar amounts, and 50% of the funds in Treasury securities that mature in less than 1 year. However, the fund uses margin and a specific borrowing strategy that gives the fund's performance the same as if they were allocated to 75% the dividend-paying companies and 25% the Treasury securities. Next, we have the Equity and Income Fund. Invest 70% of funds in common stock and preferred, and rest in mortgage-backed securities and debt instruments. Finally, we have the Balance Fund, which is literally the total return fund minus the taking on margin and borrowing strategy. Then they have an energy fund, the midstream energy fund, a gas utility fund, Japan fund, Japan small cap fund, a technology fund, and an ESG-based ETF that doesn't even warrant mentioning because it's so bad. Now, how many of these funds are actually investable? For this, I went through their website, went through Morningstar, compared. Is the hefty expense ratio that you pay for active management worth any of these results that you're getting? And I was actually able to find quite a few, especially, again, with the institutional rates. They were much better, but the Cornerstone Growth Fund did severely outperform any of the indexes. The Cornerstone Mid-Cap 30, which I keep mentioning, is by far their best one, and Neil still has his hands on that. The Gas Utility Fund, the Japan Fund, Japan Small Cap Fund, the Small Cap Financial Fund. Really just any of the funds that Neil Hennessy has his hands on, and then they have a few specific ones that really, really do well in their specific niches. Now, when going through kind of the takeaways, I feel really good in terms of their management team, specifically in Neil Hennessy. As I've talked multiple times, any of his Yahoo Finance appearances or the Schwab Network appearances, he's very reasonable. He says all of the right things. He primarily focuses on the right investments, but that doesn't necessarily mean that his company is investable. And they really have, over the years, had many ups and downs. When I was looking through terms of like what their revenues were and earnings were comparatively across the years, they really did kind of peak in 2016 with about $50 million in revenue, and then they kind of sharply dropped off a cliff. Now, I think this could be down to a multitude of things. There wasn't necessarily like they had a scandal or anything. My personal theory would be the gamification kind of investing with the Robin Hoods and everything, and really trading just becoming easy at a fingertips. It's really hard to commit to a mutual fund that tries to primarily focus on long-term growth and long-term capital appreciation, especially when at the tip of your fingers you can invest in anything that's happening on, like in the markets whatsoever. But specifically, coming back to 2024 with how incredible the markets were, they have seen a significant pouring in of new investors that want to kind of take part in some of their larger funds that do really well. But I just think some of the offerings, like in these niches such as like the energy and midstream energy and utility and even maybe some of the Japan funds, it's like, why would you want to pay a higher expense ratio for some of those that kind of eats away at the performance in a way of how your money's actually doing, when you can really easily just find an ETF? And I had these concerns, and they're very valid, because if me, as someone who I typically think of, not a beginner investor by any means, but not like Warren Buffett or Charlie Munger, obviously, but like somebody who would actually try and dig through and see, okay, how much am I getting back in terms of dividends? How much is eating away with the expense ratios? If someone like me can kind of look at that and be like, I wouldn't want to invest in that. Why would other people? I don't necessarily think I'm significantly better than everyone else. I'm sure they also have those concerns. But I was really excited to see that Neil Hennessy and the team over at Hennessy Advisors has really emphasized trying to focus on acquiring more ETFs, trying to acquire more funds and add them into some of the existing funds and maybe start more additional funds, and really just create a very, very broad network of offerings so that they will attract more investors moving forward, especially again when it's very, very easy in 2 clicks to go to VOO with a very little expense ratio and just invest in there and beat a significant portion of active and management. Now, in terms of where the money comes from, if you're going to be an investor and a shareholder in Hennessy Advisors, it's coming primarily from the investment fees and the expense ratios that investors pay to invest in those funds. And again, looking at the growth of the funds and how many new investors there have been pouring in, specifically in 2024 and the start of 2025, I really do think this is going to be on track to be one of their best years in the past 8 years. Now, short term, they have a lot of potential, and they're at a very, very cheap valuation, as we'll get into. But is this something that could potentially stay around in a portfolio for 3 plus 5 plus 10 plus however many years it takes to see a solid return on investment? I kind of think so, and really a lot of that does actually boil down to their dividend and their strategy. Now, they have kind of a lofty payout ratio. I mean, for a company that pays a 5% dividend, not necessarily. I've seen some that will go up to the 80% payout ratio to have something like that. And typically they're situated around 47, 48%. But I do really like their commitment in terms of taking whatever fees they're able to generate and primarily focusing on returning that money to shareholders if they don't have a better use of it. They've prioritized very high dividend percentages, and they've also prioritized using the rest of that to acquire additional funds and acquire additional ETFs. And then, of course, we have to deal with the capital appreciation that comes with some of those funds that really do outperform the market. So I definitely think with the strategies, looking through their funds, looking through their fund performance, and kind of understanding a little bit of what leads them to make specific investments, which in a lot of ways isn't necessarily them leading them, it's how do we get rid of emotion. I think these are attractive qualities to investors. I think there will always be a place for a company like Hennessy Funds or any fund management company that actually provides value to shareholders in general. So overall, I'm very positive on this company. Now, let's go through a bit of the specifics. At the day of recording, the closing price on Friday was $10.90. Again, I have all this information up right here in front of you, pulled this from FinViz. I've also leveraged Bloomberg Terminal and, of course, Yahoo Finance and the company's financial reporting, so like 10Ks, 10Qs, all of that nature. Just wanted to say that. I completely forgot to in the beginning, but again, don't take any of this for granted. I always am very, very transparent on where I pull this data. You can, immediately after this, go fact check anything you want. It's right there. I encourage you to, especially if anything I say influences you to maybe look at it in terms of an investment. Now, market cap, they have an $85.54 million market cap. Again, I think this is very, very appealing in terms of market cap because there's a lot of upward room for that to grow, especially with them having $4.5 billion in assets under management. Now, income, they brought in $8.73 million. Sales last year, $33.21 million. Book to share, 12. Cash to share, 8.35. There's that 5% dividend yield that's really exciting. The PE is going to be 9.79. Price to sales, 2.58. Not the most attractive in the entire world, but still quite low. Price to book, very low. Price to cash flow, still appealing. Everything in terms of that nature is going quite well. Now, past 5 years, as I mentioned, they really did kind of peak in 2016 before, especially post-22, kind of cratering down, but we have seen EPS growth, especially in the most recent quarters, and sales growth in the most recent quarters. Now, something I really like to see, insider ownership. I keep bringing up Neil Hennessy, and that's because he's one of the largest shareholders in the company, and he's the founder of the company. And I kind of do like founder-led companies because they really want to prioritize doing the best things for their companies and for their shareholders. Then, of course, return on assets, return on equity, return on investment right there. They have very high margins. I like to see that. And really, a lot of this is just going to boil down to, is this an appropriate valuation? Is this a cheap price to acquire a company like Hennessy Advisors? And do I necessarily see any value in their fund offerings? And really, the way I see it is they don't necessarily need to knock it out of the park with every single fund. I mean, they definitely haven't in any way, shape, or form, except maybe the Mid-Cap 30, where they have identified some of those big names. But I do think there's definitely going to be a role for those companies. They're doing the right actions. I mean, I spent over 2 hours almost on YouTube the other day just looking through their podcast. Yes, they have a podcast on YouTube, and they're very open and talk about what's kind of going on in the markets and make sure to let everybody know who's invested with them, kind of what the game plan is moving forward, how the markets are going. And they're also not one of these companies that'll just continuously be like, this is the best thing ever, this is going to be wonderful. I mean, even looking at Neil Hennessy's predictions for 2025, when a lot of investors were very euphoric about markets and, we just had 2 back-to-back incredible years, he was very muted and said maybe it'll be something in the 2 to 5% range in terms of target price for the Dow Jones and for the S&P 500. So I think he's very logical in terms of an investor. Here, I have a little bit of a blurb for him. I think he's very logical in terms of definitely an investor, and I think he's doing the right actions for the company specifically. And I really do like the company's focus in terms of dividends and in terms of trying to acquire more funds, especially recently, more ETF offerings, so they can kind of compete with some of the bigger companies that have very, very, very little expense ratios because they do so much business that they can afford to have those very, very, very tiny expense ratios. So I personally am going to be adding Hennessy Advisors into the Microcap Mania Portfolio. I wouldn't say it's necessarily a lock for the next 3 to 5 years or any way, shape, or form. But in terms of what's offered in microcap, specifically in finance right now, I definitely think Hennessy Advisors is probably top 2%. There's a lot of crap, I'm going to be honest, especially as I mentioned before, every regional bank ever is a publicly traded company, it feels like, and none of them have any like real growth aspirations. It's how can we pick up a few more customers from the next town over? We're losing market share here. Our deposits are either increasing very slightly or decreasing, and our company's stock isn't doing well. And that isn't necessarily the same with Hennessy Advisors, where it's like they really had a long-term, like very, very high performance. Gamification came out, 2022 came out, and now they're kind of picking themselves back up. They're getting in more and more investors into their funds, and the quality of the funds didn't drop through any of that. So overall, I think this is a great pick. I appreciate you for checking out today's video very, very much. It means a lot to me. And if you have any thoughts, concerns, anything at all, feel free to drop a comment, and I look forward to seeing you in the next video. Okay, thank you.